Hello, everyone. Good afternoon.
Hello.
Hi, Aura. I've been screaming all this time, not realizing that my microphone was muted, right? And I thought everyone was just, just logged in and but not present. Um, Hello, Chris. Are you there, Chris? Hmm? Chris? Angel, are you there?
Yes,
Hi,
Professor.
Chris. Yeah, I see
Hello,
you. I see your
Professor.
microphone. Yeah, hi. Angel, are you there? Angel Mendoza? Angel? Hmm? Antonio. Antonio
Hello,
Sujerin.
Professor.
How are you? How are you?
I'm good.
Good, good. Jacob. Jacob, are you there, Jacob?
I'm here. I'm here.
Good, good, good afternoon. Keisha, how are you, Keisha?
I'm good, Professor. How are you?
Good, good. All righty. So I see six people in the collaborate and in the forum. Today's forum. Let's see how many people are there. Seven. So it's pretty much only one person is missing. Koulibaly. Koulibaly. Koulibaly's not here. Um, I hope he's gonna join shortly. So let's see. So I'm sharing my screen, right? So you can see it. So in our last class, uh, basically, we talked about the factoring, how it works, why it's called factoring, and how factoring works. Uh, so we are pretty much done with the working capital. In other words, in working capital, right, there are roughly in like five, six line items in the order of liquidity. Of course, first, cash and cash equivalents. Yeah, most liquid because they already it's already cash, and then marketable securities, which mean stocks and bonds, and then promissory notes and accounts receivable. These two line items were the ones that were subject to factoring. And I told you, factoring is just another name, uh, uh, the name used in the industry, right? And I told you in financial mathematics is called simple. Oh, oh, I see. What's simple discount? Oh, no, no, no. Simple discount or bank discount, right? What happened was, yeah. Oh, it was so. Mm, all righty. Uh, the whiteboard got so. Uh, the whiteboard was acting up, but okay. So as I said, bank discount or simple discount. That's the name used in the financial mathematics, right? And in the industry, it's called factoring, What happened? What's going on? All right, and then the last line item in the current assets is inventory. And inventory is, if you think about it, current assets are liquid assets, right? By nature, it's all short-term assets. Short-term assets are liquid. In other words, short-term current means, I've been telling you this, current in this context, in the context of the assets, current means liquid. Because in this context, current means like the current in the stream of water, right? Current means, like Gulf Stream, because only liquid things can run. Current means running, actually, right? Of course, what is the current status of X? It means, what is the, present status. But how it came to mean that originates from the word, in French or in Spanish, in Italian, there's a word like, in French is courant, right? Courant, fluent, right? Whatever is running, it's fluid, right? Running, liquid is fluid, and liquid is running. It's fluid. So if you are stuck, if you have a solid object is stuck somewhere. It doesn't easily run, right? But liquid runs easily, right? Therefore, if you're all caught up, you are current, right? You're current with something. And if you are stuck in one place, you cannot be current, right? And you should be fluid, right, to be current. I mean, your mindset should be fluid. But if you think about it, inventory is not liquid asset, but it's not fixed asset either, because inventory is not means of production. It's an input. Inventory is an input of production, input to production, right? Of course, inventory can be, so inventory is rather physical in nature, but it's not a long-term asset, because it's not means of production. It's not physical capital. It's just physical in nature, but it is input, and it can be turned into, it can be liquidated relatively easier, more easily. It can be liquidated relatively more easily than the fixed assets, right? An inventory consists of three different categories. For a manufacturer, inventory can mean raw material, right? For a manufacturer, inventory can mean raw material, goods in process, and finished goods, right? And most of the times for a manufacturer, inventory means raw material, right? Because Finished goods can be, part of the manufacturer's inventory, but you wouldn't keep the finished goods um, on your site. If you're a manufacturer, your site means your plant, and you wouldn't keep the finished goods on your site for long, right? That wouldn't be a very good. That if you are having a lot of finished goods on your site, um, that means you're stuck with the products that don't sell. Now think about it. If you're a manufacturer and you made something, they are supposed to be shipped out already. They are supposed to be shipped out to the retailers, right? And retailers must have ordered those goods already, right? So they must be shipped out, and it must be in the warehouse or the store space, right? The stock room of the store of the retailer. And if the finished goods are still with you, the manufacturer, then that means you are making things that are not very popular. You're making things that don't sell. So, although finished goods can be part of the retailer's inventory, most of the times you would find them in the retailer's inventory, not the manufacturer's inventory, right? Um, and the manufacturer's inventory would generally refer to um, uh, the raw material, right? Of course, it would also have to include goods in process, um, but think about it: goods in process or work in progress. It's hard to put dollar value, right? It's hard to put dollar value to goods in process, isn't that right? Raw material, you can put the price on it. Raw material, you must have paid something. You must have paid, X amount of dollars for raw material. So you can put dollar value on it. Also, you can put dollar value on the finished goods because if you are making computers, right, and Model X has a price on it, and this price is, of course, the manufacturer's price. And as it leaves the factory, hence it's also called X factory price. And at the retail store, it will have a different price, retailer's price, right? Retail price. But for you, at least for the manufacturer, it still has a price. So you can put a dollar value on it. But goods in process, it's a question, right? What kind of dollar value can you put on it? You cannot put raw material value on it because there is added value. But it's questionable yet. You cannot put finished good price on the work in progress because think about it. How else goods in process or work in progress are like half assembled, only half built, half assembled, or partially built. So it's hard to put a dollar value. I mean, if you are, think about it. It's just simple, as a simple analogy. If you have a bakery, right? You have flour, you have raw materials such as flour, sugar, or other ingredients. All of them you can put dollar value on it because you paid something. And when they turn into finished goods, you can put also dollar value on it, right? Bagel or donuts or whatever, you can put dollar value. Loaf of bread, you can put dollar value on it. But while it is still in work in progress, while it is still in goods in process stage, it's hard to put a dollar value on it. Isn't that right? Obviously, it should be valued more than just the raw material because it is, there is more value added than just the raw material. but it cannot be, it's not a finished good, so you cannot put the value on the goods in process should be less than the value of the finished goods, but it should be greater than the value of the raw material, right? But the thing is, it's hard to put dollar value on it. But anyway, for a manufacturer, inventory means inventory includes three different categories, right? And they can be sold. I mean, if you are in, once again, what is the reason for current assets? The current assets exist current assets are also called working capital. What is working capital? Working capital is literally the capital that is needed to run, to support the operating activity, right? To support the operating activity. And what is the operating activity? I've been telling you, you make something, right, and sell something and receive payment for that. That's and arrive at and pay out. When you sell something, you have revenue, right? That's the payment. Revenue doesn't have to be in cash, right? It could be in revenue can be form of promissory note or accounts receivable, right? In other words, invoice. But either way, the operating activity means, basically making something, selling something, and then receiving, payment, and subtract expenses and arriving at operating profit or EBIT, right? That's the, you see, remember, from in the income statement is basically capturing the operating activity from revenue to here, right? Operating income, that's operating activity. So you need to have something. You need to have some capital or funds to support the operating activity until that operating activity generates first round of income, first round of revenue. Current assets, therefore, are called working capital. And I've been telling you, you have to pay out expenses, and those expenses, in the short run, why isn't it? These things are not responding. Okay, I'm gonna have to, maybe I'll have to, yeah. And then you have current liabilities, right? Current liabilities are the current liabilities, right? And the current liabilities are, payments that are becoming due in the short term. In other words, under 1 year. There's accounts payable, notes payable, accrued interest, wages, accrued wages, and taxes. Those are short-term payments to make, right? And where does that, how do you pay, how do you meet those payments? How do you make those payments? How do you meet those liabilities? The source of the funds to pay for current liabilities is the current assets, okay? So that means you must have you must have at least as much current assets as current liabilities, right? So you might think, oh, so if I have just enough current assets as the current liabilities, then I'll be okay. No, you're not okay. First of all, um, if you have just enough current assets as current liabilities, all you can do is just simply you can meet the current liability, you can make the payment, but you have no working capital left, right? You have no working capital left. In other words, okay, what does this mean? If current assets is equal to current liabilities, then that means this ratio, the ratio will be current assets to current liability ratio will be 1. If it is 1, you're not okay. Why? Then you have no more working capital left. In other words, I think it takes two. I'll have to start a new one. I think it's. All right, it's taking too much time, so let me. So here, let's think about it. So if you have, in other words, the ratio between current assets and current liabilities must be greater than 1. Actually, the rule of thumb is it must be greater than 2, or at least equal to 2. That means, after paying out the current liabilities, you will still have net working capital left. I mean, current asset is called working capital, right? So if you subtract current liabilities, right? It should be called net working capital. And if the ratio is 2, that means the net working capital is the size of the size of the net working capital is almost, if it is 2, it's exactly the same as current liabilities, right? The size of the net working capital is exactly the size of the current liabilities. And if the ratio is 2, that means, current assets is 2 times current liabilities, right? If this ratio is 2, right? If this ratio is 2, that means current assets is 2 times current liabilities, right? Now, in other words, we'll need positive net working capital, and this net working capital better be at least the size of your regular current liabilities. In other words, you must have at least twice as much current assets as current liabilities. Okay, that's the rule of thumb, and that's the bottom line. If that way, even after meeting all the current liabilities, you will still have some working capital left that can support even uh, another round of current liabilities, right? I mean, not around another round, or rather, ordinary your average level of current liabilities, right? So the whole point is this is called current ratio, right? This is called um, current ratio. And if the so current ratio is less than 2, I'm not gonna. If the current ratio is not even 2, then you have a problem, right? You have a problem. You may default. I mean, the chance you have high chances of default, and you will sure default. You will sure default if this ratio is not even 1, right? If this ratio is not even 1, you are sure to default, right? And it's a very serious problem. Companies do not default because of long-term liabilities. Companies don't default because of long-term liabilities, right? Because long-term liabilities are anyway paid over time. Long-term liabilities, and what matters is short-term liabilities, because short-term liabilities are mainly the interest on the long-term debt, and if you default on these interest payments, if you once or twice they may forgive you once or twice, but if you repeatedly default, then they will take you to bankruptcy court to get bankruptcy judgment, and once they get bankruptcy judgment, then they can seize hold of your assets, which mean assets. What assets? These plant and equipment, right? Plant and equipment, building and land. They will um, seize these assets, and they want to sell it off to recover their interest and principal, right? That's why it's short-term liabilities are very important, because companies can go bankrupt because of not being able to pay short-term liability. So the current ratio is a very critical number, current ratio, and bottom line is it has to be at least 2. Okay. Now let's see if I can. Yeah, let me delete other things. Maybe having too many of these open. That's why it's slowing down everything. All right, that wraps up everything about the balance sheet. Of course, we uh, 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 the current liabilities are quite obvious. Accounts payable. I mean, if you have accounts receivable, that means your client, your buyer, has accounts payable to you, right? If you have promissory notes, that means your buyer has notes payable to you, right? And the same thing to you. It's the same thing. If you bought something with promissory note, you have notes payable. If you received shipment of goods, right, without paying it on site at the time, then you have accounts payable. Instead, you have invoice for that, right? I'm not going to talk about the accrued wages at this time because we are kind of behind, and the main lecture has already, extensively covered what is, accrued accruals, right? So please refer to the and the past lectures. I've been telling you, and no matter how many times I talk about this, some people never take heed. But I've been telling you, all the past lectures are on my YouTube channel. So go to, it's only a matter of looking up. It's only a matter of looking up. Okay. fnb100. Go there and go for factoring and financial statements, and yeah, right. Go to read all of watch all of these videos. Financial statements. 1, 2, 3, and factoring 1, 2, 3. All of those. Okay. All right. And then, so that wraps up everything about the financial statements. That wraps up everything. Oh no! That I almost forgot. That's not it. We still have. So now we understand that the goal of the income statement is basically to explain the process, explain the process leading to net profit, right? So, okay. Income statement. Income and expenses, right? Two sources of income, right? Two sources of also expenses, right? Revenue and investment income. Let's call that, it's hard to write, call it passive income, right? Investment income is a kind of passive income. Expenses, two sources of expenses, right? CGS and operating expenses, right? And then if you subtract that, you arrive at EBIT, right? Earnings before interest and taxes, or another name is operating profit. Okay. Now, I don't think I need to go over everything, but the whole point is, remember why we started on topic 2. At the beginning of topic 2, I told you what we are interested in is return on investment. How do we, from the firm's perspective, right? In microeconomics context, because in the topic one, it was return on investment from macro context, right? From macro perspective. But in topic two, uh, uh, how do we understand ROI from microeconomics perspective? And therefore, in other words, from the firm's perspective, right? So how does the firm define the return? And to understand that, right, we had to go through all this. And from EBIT, you must pay interest first because that's what EBIT is telling you to do. So you pay interest, and then the result is called because I because interest is gone, right? It's gone. So what should it be called? Then it should be called EBT, earnings before taxes, and this another name for that is taxable income. Then you pay taxes, right? Then you arrive at EAT, earnings after taxes, which is, net profit. Now, think about it. Net profit, this is what, why we are, if you think about it, this is the return on your investment. Isn't that right? This is the fruit of your investment. This is the fruit or the output, right? This is the output of your investment. Then think about it. If there is an output, there must be an input. Isn't that right? There can be no output without input. So what is the input? Now, the input, there are two. Think about it. We need to a lot of things in a lot of things in I shouldn't say life, but a lot of things around you. We're doing those things because they are productive and they are efficient. For example, gas mileage. Gas mileage is a good example of output to input ratio. Now think about it. When we say return on investment, that means it's output over input, isn't that right? Right? Invest. Remember, when we defined in the first topic, as an example of return on investment, we talked about holding period return. And what is holding period return? It is defined as capital gains, right, plus income during the holding period, So hard. Over initial investment. Initial investment. What is, in other words, we put it into verbally in different forms, but basically the whole concept is simply this. What is capital gains? We all know if you're over n year holding period, right? You will have capital gain of PT plus n minus PT, right? Isn't that right? Because think about it. If you bought a stock or a bond or any asset, right? Financial or non-financial, your initial investment is PT, price at time T. Isn't that right? Your initial investment is price at time T. And during the holding period of n years, right? PT plus n minus PT is the capital gain. Isn't that right? As long as PT plus n is greater than PT. If it is not, then there was capital loss, right? Well, capital loss is the same thing as negative capital gain. And plus sum of all the cash flows, during that period, right? During time t to time t plus n. Right? But then think about it. This is the output, right? If you think about it, the numerator is the output. This is the output. The whole numerator is the output from or of this input. Right? And the higher this number, the more productive or more efficient that investment was, right? It's the same concept as gas mileage. If you think about gas mileage, what is gas mileage? We all know what gas mileage is. Is there anyone who doesn't understand what gas mileage is?
Gas, like how many miles are on your car, right?
Yeah. But actually, yeah, Khalid, actually the on your, rather than, how many miles on your car, how many miles on the gas, actually, if you think about it, right? Gas mileage is what's gas mileage? We all understand. Suppose you have it's how many miles per gallon, right? How many miles per gallon? So suppose, how do you calculate the gas mileage? Of course, it's simple. Suppose your car has 20-gallon tank, right? You fill your tank, gas tank, just 20 gallons, and then you drive until you run out of gas. And if you got 600 miles right? You ran out, and you got 600 miles. What's your, how many miles per gallon is that? It's easy, it's 30 gallons. 30 miles per gallon. That's gas mileage, isn't it right? And the higher this number, right? The higher this number, right? It would be better. For 20 gallons, if you got 800 miles, it's better. That's 40 miles per gallon, right? Who wouldn't like it? It's not a rational, obviously, a rationality is something like this. More is better, right? More is better. So the higher the gas mileage, right? The more is better. The bigger the better, or the higher this number, higher the better. Any rational person would prefer a better gas mileage than a lower gas mileage. Isn't that right? But gas mileage is just one example, and the term mileage can be also it can be used as a metaphor in a figurative sense. They also say, if you have three options, 3 or 4 options, option A, B, C, D, and then what is your decision criteria? How do you make the choice? The choice is which one gets you the best mileage, right? Which one gets you the best mileage? And then it's not only, you might think, is it about car? No, not only car, but you have, let's say you have, you are in a situation to make a choice. You have even for going out for lunch. You make this decision all the time, isn't that right? Do I go to McDonald's? Do I go to Burger King? Do I go to or Chipotle? Or you're making this decision all the time. Do I go to Pret a Manger? And what's the price? The price is the input, and what do you get for that? Do I go to Subway? What do you get for $8? Do I get So basically, you're making that evaluation all the time, isn't it right? And you get, in other words, expressions like most bang for the buck, right? Or you get the most bang for the buck. I'll go to Subway because I get the most bang for the buck. What does that mean? I get the most value for money, isn't it right? Also, sometimes they say I get the best mileage out of this. It's a figurative. It's a figurative expression, right? It's not only about the gas mileage. When you say you get the best mileage out of this, then that's a figurative expression, isn't that right? That simply means So most bang for the buck. If you get the most bang for the buck, what does that mean? That's the output to input ratio. Isn't that right? Output to input ratio. You get the most output for the input. So same idea, right? When the companies measure their return on investment, there are two ratios they are most focusing on. Return on asset and return on equity. Okay, return on equity. The time is 1:53, so I think it's a pretty good the right moment to take a break. So let's take a 10-minute break and reconvene exactly at 2:03. Okay, 2:03. Let's take a
Okay.
10-minute. Okay. All right, we're back. We're back. Hope everyone is back. So now let's think about the return on assets and return on equity, which is basically output to input ratio, right? Actually, there are two versions of return on assets. First, let me do the return on equity first. So think about it. Return on equity is literally, the fruit of the company's operation is basically EAT, right? The net profit, right? And the input, this is the fruit, in other words, output, right? But then what, this fruit belongs to whom? Anyone? Who does the profit belong to? Who does the company's profit belong to? Hmm?
To the owners?
Yes, the owners. Yes. And who said that? Who said it? Aura? Yeah. Okay. Why don't you? Yeah, Aura. So you're gonna get 0.225. This is fnb100 section 1300, right? Okay, today's tip. Yeah, Aura, you got 0.25. Yeah, owners. And what's another word for owners? What's another word for owners? Hmm? Look.
Investor.
Yeah, but the investor is a kind of broad word because there can be two types. Huh?
Shareholder or stockholder?
Shareholder. Yeah, stockholders or shareholders. In other words, you remember the capital came from two sources, only two sources, right? Capital came from only two sources, nothing else. Capital came from either equity or liabilities, or liabilities is debt, right? Liabilities. And just because the word is liability, some people cannot associate it with debt. Liability is debt, right? So capital came from only two sources, right? Equity or liabilities. And that's why I told you it is called, that's why I told you balance sheet. The goal of the balance sheet is to explain the capital structure, right? Remember that the goal is to explain. Of course, accounting class will say it's mainly to show you the how total assets are composed of, and how the liabilities and equities break down. Yes, that's true. But I've been telling you this over and over. Before assets, there was equity and liabilities. In other words, before assets, there was source of capital, right? Source of capital is only two, either debt or equity, right? and assets are only, so you raised, $10 million, the capital of $10 million, and the source of that 10 million was, that capital was debt and equity. And assets are simply how this 10 million is held. You understand? Assets are just, where this 10 million is used, right? How it is held. So its source, right? Before use of capital, there must be before use of capital, there must be source of capital, right? You cannot have assets without debt and equity. You understand? Without raising capital first, you cannot have assets. So that's why source of capital comes first, right? And how this debt and equity is, what proportion, right? In what proportion this debt and equity, in other words, what is the mix, right? What is the mix of debt and equity? What's the ratio of mix of the mix? What's the proportion of debt? What's the proportion of equity out of this total assets? In other words, out of this 10 million, what is the what kind of mix is that? That's called capital structure, right? That's why I said, and in our example, in this example that we've been using, total assets, and they must balance out. That's why it's called the balance sheet. Total assets must be equal to total liabilities and equity. They must balance out. If it doesn't balance out, if your balance sheet doesn't balance out, then it is inherently wrong, because it doesn't satisfy the term balance sheet. If it is not balanced out, it cannot be balance sheet, right? So and this is almost 10 million, right? And the composition of debt and equity is like 40% equity and 60% debt, right? That's capital structure. 40% equity, 60% debt, right? That's the capital structure. And who said that? Stockholders. Who was that? Who said stockholder, shareholder, or stockholder? Who said that?
I said it.
Okay,
Hello?
I can't see. Who is I?
Khalid.
Khalid. Okay, Khalid,
Yeah.
right? Okay, Khalid. So you got 0.25 for that. You're welcome. Now, owners. So this net profit, which is the fruit of the operating activity of the company, that belongs to the owners. Owners are called stockholders, shareholders, but also equity holders. Stock is equity, okay? Equity holders. Then that means, this fruit is the result of the input. I mean, input is not the exact the term here, but this fruit, EAT, is the result of workings of equity. But of course, this is limited, very limited concept. Why? If you think about it, this fruit is the result of workings of the total assets. Isn't that right? Why? Because total assets is like the tree, right? So I said there are two versions of return on assets. version number 1. ROA, return on assets, is this EAT over total assets. Version number 2 is EBIT over total assets. Now, why? Think about it. Why do you have total assets? I mean, how do we define assets? Do you remember how we defined assets? What's the definition of assets? Anyone?
Asset is what you own.
Yeah. That's accounting. That's typical accounting definition. Assets are what you own. Liabilities are what you owe. But then that definition is kind of incomplete. And who said that?
Sorry, it was me.
No. Who said that? You didn't say that.
Oh no,
Oh,
sorry.
A girl.
I had my mic on, sorry.
Huh?
Aura, yes.
Aura. Okay, Aura. So you got another 0.25, but okay. Brian, was it you, Brian? It's okay. I don't know why you why you I was just asking what was the I didn't quite understand what you said, but my question was, what is asset? And Aura said it's what you own. But then that definition is kind of that definition is incomplete. Why? Yeah, in accounting class, they will tell you asset is what you own, liabilities are what you owe. But that doesn't, it doesn't fully answer the question why. If you define it by own or owe, then what about equity? What about equity? Is equity what you own or what you owe? First of all, who is you here? Own or owe can explain only, it explains only assets and liabilities, but it cannot explain equity. Now, if liabilities are what you owe, that means that's the debt. It's the debt, right? So debt came from the lenders, but then equity came from the owners of the company. Equity came from the owners of the company. So you don't owe equity. I mean, equity is what you own, not what you owe. Isn't that right? Because equity came from owners. So how can you then? A very mind-boggling question. The mind-boggling question is, if equity is what you own, right? Why is it on this side? Why is it on the side of the liabilities? It is, if it is what you own, shouldn't it be on the side of the assets? No, it's on the side of the liability. It's on the liability side. Why? Because it's the source of the capital. It's the source of the capital. So in other words, I told you the balance sheet is showing you where the capital came from, what's the source of the capital, which is, source of the capital is this liability side. That's the source of the capital. Isn't that right?
So in other words, equity is like what the company owes to the owner?
Yes, you're right. If you define it by own or owe, right? Equity is what the company owes to the owners because it came from the owners. So that's why it's on the liability side. Okay. Um, so sometimes if you put yourself in the but it's hard to put yourself in the company's perspective because company is an inanimate object, isn't that right? If you think about it, company is not a company is not a person. A company is not an animate being. A company is an inanimate being, although it's a legal entity considered as a legal person, right? A company is, since company is nothing but a company is um, a vessel in a way, isn't that right? So uh, a company is nothing but a vessel. And whether you own something or owe something, think about it. Does the company own those assets? Yeah, legally, yes, legally. But who is the ultimate owner of the company? Who's the ultimate owner of the company? Hmm? As I said, company is an inanimate being, right? It's just um, a company is just a vessel. Vessel for what? Vessel for channeling the profit to the owners. Isn't that right? So a company is like a tool, right? Isn't that right? Using the company. Um, so eventually the profit doesn't belong to the company. Isn't that right? Eventually the profit belongs to the owners, right? You get the idea? Hmm? The company is nothing but a tool or vessel to channel the profit to the owners. Isn't that right? So the company being an inanimate being, how does it? I mean, it's awkward to say that the company owns or owes, right? But anyway, in accounting, they say, a company, in accounting, they say assets are what you own, liabilities are what you owe. But then who is you there? If uh, if you means the owners, right? Then owners don't owe the equity to owners. You don't owe it. I mean, you own it. Isn't that right? Owners own the equity. Isn't that right? So you should be careful about that pronoun in you in English language. It's very commonly. I mean, it's like you can mean. It doesn't mean exactly you. It doesn't have to be you. People in general, right? You means people in general. When they say uh, uh, you normally pay first, and then you don't pay first. You in the diner you eat and then pay later, and that you doesn't mean necessarily you. You understand that, right? You is just people in general, right? It's like one doesn't pay first. I mean, to be exact, one doesn't pay first, but one pays later after finishing the meal at the diner. I mean, that's one is the correct pronoun, but in English language, you is very generally used to mean people in general. In French, it is on. On is like one, but in French, instead of vous, they use on in case it means people in general, like one. Um, so if you say asset is what you own and liabilities are what you owe, then it becomes quite questionable. It becomes very unclear whether you owe the equity, right? You owe the equity. If only the subject is the company, then it makes sense. Company owes the liabilities to whom? To the lenders or the creditors, right? And the company owes the equity to the owners. But the company is nothing but a hollow shell. Company is a tool, right? It's just, just legally and formally, company owes the equity to the owners, but owners own the company, right? Owners own the company, right? So anyway, the point is, calling but you forgot the very fundamental definition of assets. Assets are what's the most crucial definition of asset? I must have said this before. Assets.
I was gonna say, they are resources, like they have the power to generate income.
Yeah, that's the point. Power to generate income. Power to generate income. That's the definition of assets, right? Power to generate. And who was this? Was it Aura again?
Yes, yes.
Okay, Aura. So you're getting another 0.25 for that. Yes, assets must generate income, right? That's the most important aspect of asset. So yeah, so think about it. When we say total assets, right? Total assets. We all know it's debt and equity. So hard to write. So think about it. If the company's net profit is, let's say, $2 million, it's not. It's the result of the workings of both debt and equity, isn't it right? This 2 million, which EAT, which is the fruit, right? Fruit of the output of the company's total assets. I mean, you have total assets, and in our example, 95% of total assets was fixed assets. 95% of the total assets, right? Remember, in this example, almost 95%. Look, before depreciation at time zero, right? 95 million. I mean, 9.5 million out of 10 million. 9.5, 90%, 95% of the total assets was of plant and equipment, right? So what does that mean? Basically, you want the total assets to be, total assets must generate income. They must be, total assets must be resources or the tool for generating income. And if the assets are not being used for that purpose, I mean, assets have only one purpose: to generate income. And if it is not generating income, then it is, completely useless as an asset. Isn't that right? So I don't know if it was in this class or in another class. I said something about. Did I use that? 100 square feet, 100 square feet land in a lot, 100 square feet lot in Midtown Manhattan. Did I use that example before? You guys remember that example? Maybe I didn't, right? Maybe I didn't in this class. Now think about it. So total asset, in other words, plant and equipment, right? Plant and equipment is only fixed assets, right? But let's say the company has, in our example, the total out of total assets, the fixed assets were almost 95%. So plant and equipment, that's like muscle, right? Think about it. If you're 6 feet tall and you're 200 pounds, which one would you prefer? 200 pounds of muscle or 200 pounds of fat? Huh? Tell me.
Muscles.
Of course. Why? Because if you are 6 foot tall and 200 pounds of muscles will produce a lot of muscles can deliver muscles can deliver a lot of work. In other words, if you are 200 pounds of pure muscle and bone, right? Of course, in reality, you cannot 0%. There can be no 0% fat. If you 0% fat, you will crumble, right? I mean, cartilages, old cartilages or synovial fluid and joints, you need fat. Otherwise, your bones will crackle, against each other, right? It will grind. The bone will grind against each other. Your joints will. You can't. But my example is kind of extreme case. But someone 6 foot tall, but full of fat cannot. Let's say there is 1 ton weight, not maybe not 1 ton, but like there is 500 pound weight or 1,000 pound weight, 1,000 pound weight at point A, and if you are just 200 pounds of pure fat, you cannot move that 1,000 pound of weight from point A to point B. But if you are 6 foot tall and 200 pounds of pure muscle, moving 1,000 pound from point A to point B can be achieved, right, with some effort, right? So plant and equipment is just like that. Plant and equipment is like muscle, right? And it can produce output. I mean, moving the 1,000 pound weight from point A to point B is the output, right? It's the work being done by your, the tool or the vessel or plant and equipment called muscle, right? So think about it. Total assets is like a tree, right? And this tree is a fruit tree. You bought this tree, and this tree is $10 million, right? And let's say 7 million is equity, right? Equity of 7 million. And debt, that means debt is 3 million, right? You borrowed, so owners, the equity holder owners, let's say there are 10 owners, that means each chipped in like, at least like $700,000, right? There are 10 owners, paid in 7 million, and then borrowed 3 million from the bank. So bought this tree. So the tree is $10 million, and it's gonna 1 year later, it's gonna bear fruit. Okay. at harvest, right? 1 year later, you harvested 2 million fruit. And this 2 million, and these fruit belongs to only equity holders. I mean, eventually, I'm sorry, I'm gonna get to that. But these fruits were not possible if there was no debt, because the tree is $10 million and the equity was only 7 million. You couldn't have afforded it, right? So with debt. So in other words, these fruit, 30% of this fruit belong to debt holders, at least. Isn't that right? 30%. In other words, debt holders, the bank cannot have claim on the fruit, because fruit is the output of the tree, and only owners, only it belongs to the owners. But what you can do is, but one thing is clear, this 2 million fruit is the result of the workings of debt and equity, both debt and equity. So 70% of these fruit is the result of 70% of this fruit owes to equity, 30% owes to the debt. In other words, but then what belongs to the debt holders is only the interest, right? What belongs to the debt holders is only the interest. So what they can do is, if you sell this fruit, right? There are 2 million fruits. So if the fruit is, if you can sell it for $2, and there are 2 million, right, of them, so that's going to be 4 million, right? And then out of 4 million, you pay, let's say the interest is 1 million, so you pay out interest 1 million, right? Then 3 million is the result. 3 million is the output, right? That belongs to the owners, right? So of course, then 3 million. In other words, that's EAT, right? 3 million is EAT, basically. So in other words, when you measure, so now this explains what return on equity is. Return on equity is basically, measuring the, it's a way to measure the productivity of equity, right? In our example, it will be 3 million over 7 million. In other words, 7 million was the it's the resource. I mean, it's not input exactly, but because I started out with input-output ratio, right? You can consider that as input, but it's not exactly input. I mean, it's just it's like plant and equipment, right? Plant and equipment. So it's a tool, right? When we calculate the gas mileage, gas is consumed. It's literally input. You have to burn gas, right, to get 600 miles, right, 20 gallons of gas to get 600 miles. But you don't burn up the car. So in other words, this equity is like the car, not the, but you say the car is the, tool to get you, or the vessel to get you 600 miles or 30 miles per gallon. But still, if the gas mileage is 30 miles per gallon, that's basically the efficiency. It's the efficiency of that car, isn't that right? So the equity is the basically because the EAT belongs to the owners or the equity holders, right? If you take the output to input ratio, and this 3 million is the result of workings of equity. Actually, 3 million is the result. This 3 million is the result of the workings of the equity. It's only right to divide it by the 7 million, and then this will give you like you can easily calculate it. It's not 50%, but it will be something like 40 something, right? 40% or that's the return on equity. And of course, one thing you need to make clear is that this is the EAT at times 1, and this is the equity at time 0, because that's the initial. Equity at time 0 is the initial investment, right? Initial size of the plant and equipment, right? Initial capacity of the plant and equipment. The initial capacity of the equity, right? That produced net profit at time 1, right? Now, then think about it. Return on assets is basically, there are two versions, right? Return on assets is literally the way to measure the efficiency or the productivity of the total assets. So you divide EAT by total assets. But if you think about it, we all know total assets is debt plus equity, right? Debt plus equity. And you understand equity, net profit belongs only to the equity holders. This has nothing to do with the debt holders. From the debt holders' perspective, using EAT as the output is a bit unfair because they don't have anything. I mean, of course, debt contributes to EAT, but from the debt holders' perspective, EAT is not means nothing to them, right? So in other words, in our example, the fruit, when they were sold, right? The fruit, when they were sold for $2, the total revenue is like 4 million, right? This is not revenue in this case. I mean, the example is kind of mixed up. This 4 million is more like EBIT. Right? Operating profit. From the operating profit, they paid out 1 million as interest. And so debt holders got their interest. Actually, the productivity of this tree as a total asset, the productivity of this tree as a total asset is better measured. It's better measured by, it is better measured by the second version, right? Because EBIT is the more appropriate output when we consider also the debt
Okay.
holders, because debt holders' total assets also come from.
Answer ginger man.
Say that again. Someone was saying something. Was someone saying something? If you had a question, go ahead. You don't have a question, okay? Then,
Sorry, I'm so sorry, Professor. It was by accident because Hello?
yeah. What? So what? You were asking me a
I
question, or
made
was it a background
no.
noise?
It was background noise.
Okay. You were you were talking to someone else. Okay.
Yeah.
All righty.
When does
Um,
this class end?
2:40. So we are like 4 minutes past. But let me just wrap it up. So yeah, on Monday it's from 1 to 2:40, right? Wednesday just 1 hour. So again, just like EAT, right? Just like EAT, it has to be the EBIT at time 1 and the total assets at time 0, because that was your initial investment, right? Yes. All righty. So my tree analogy, I hope the tree analogy helped clarify. I don't know if it could clarify, or it could help, or it did help, or it didn't, but it's pretty much like that concept. Okay, so this is how the companies uh, this is how companies measure their return on investment, right? Uh, two most representative ratios to measure the profitability or the return on investment on the firm's operation. Okay, alrighty. So the time is up. So I'm gonna have to let you go now. The class is dismissed. So I'm gonna stop recording and sign
Thank you,
out.
Professor.
All right, you're welcome. So have a great afternoon, everyone.
Okay, thank you. Bye bye.
All right, you're welcome.
Okay, bye bye.
Take care, everyone. I'm signing.